It's time now for the big picture. Let's welcome in Collin Martin, Director and Fixed Income Strategist, Schwab Centre for Financial Research. Very good morning to you, Collin. Happy Friday. So no surprises there from the PCE data. Does that set us up for two more cuts?
We're not sure just yet. You know, if we look at this morning's release, no surprises, I think, is a good thing. We're looking to make sure we're not seeing any reacceleration or significant reacceleration in inflation right now. So even though the numbers came in as expected, the markets, I think, digested that pretty well. It's still really high, and that's a concern that we have here at Schwab about that push and pull between, a softening labor market and inflation that's still just too high. And if you look at, core PCE, which is, of course, something that the Fed's paying a lot of attention to, it's just still too high, 2.9% on a year-over-year basis. We saw the month-over-month come down a little bit relative to last month, but still at, annualized rates that are above the Fed's target. And I think that it is going to lead to a really, lively discussion at the next few meetings. Because if we look at comments from various officials, and if we look at the dots that we got at last week's meeting, there really is a wide range of views. And I think it's going to be a challenge to get all the voting members on board, given that we're seeing this wide dichotomy.
Yeah, it's interesting, isn't it? Because if you look back on the week, some are having a tough time sort of dismissing inflation right now. The Austin Goolsbys of the world don't believe that we should be sort of front-loading those rate cuts and we should just be keeping an eye on those prices. However, perhaps encouragingly, we did see some of the inflation expectations moving lower in the consumer sentiment survey that we got out today. So what do you think the next catalyst is going to be as far as the data is concerned ahead of that next decision come October?
I think it's going to be each of the actual numbers. And we do look at expectations, of course, whether it's, tips break-even rates with inflation, whether it's the University of Michigan expectations. But we are going to be taking each incoming release with inflation in the labor market. I think next Friday's labor market report will, of course, be very important. But especially given that we're seeing the consumer and individuals remain resilient. And this is something that we're kind of struggling with. Yes, there are cracks in the labor market, but we're not seeing that in the economic data just yet. We got an updated or revised final second quarter GDP report yesterday. It showed that the second quarter GDP rose by another, upwardly revised again. And then personal consumption, that's the driver of the economy, revised up to about 2.5%, followed by this morning's, August real personal spending coming up a bit strong as well. And that shows that maybe the third quarter is going to be strong also. So we have this, economic, I don't want to call it a strong engine because there are signs of cracking, but we're still at or near trend growth. Consumer spending remains resilient. And I think this is going to be, really interesting to see how that evolves. If we see a very, very weak labor market report next week, I think that's probably enough that maybe Fed officials can maybe cut again in October. But if it comes in somewhat tame and if the unemployment rate, remains at 4.3%, if non-farm payrolls maybe surprise to the upside, maybe we get some positive revisions for the past few months, I think there's a number of officials like Goolsby, as you just mentioned, that might be a little bit more reserved in how they approach that, knowing that they want to balance both of their mandates.
Yeah, it's some pretty conflicting data, pretty confusing, and herein lies the conundrum, no doubt, for the Fed and for your team over at Charles Schwab to make sense of it all. I suppose that's why Liz Ann Saunders sort of calls the economy brought to you by the letter K as well, because we are continuing to see this bifurcation. I'm just wondering, Collin, what do you make of the moves in the market this morning off the back of this? Obviously, they kind of got what they wanted, given that the headline number came pretty much in line with expectations. But I know you focus on fixed income. We've seen a little bit of a move in the 10-year. It sort of seems to be sort of flip-flopping right now at about 418. So where do we go from here, do you think?
With the 10-year yield and long-term yields in general, we're not sure there's much to go from here. And what I mean by that is it might just kind of hang out in its current range, even if the Fed does continue to cut rates. And we've been talking about this with a lot of our clients. We've been talking about that relationship between long-term yields, like the 10-year Treasury, and the Fed funds rate. And even in the face of potential rate cuts, we think elevated inflation and fiscal concerns might keep that 10-year Treasury yield high. If the Fed's cutting rates into call it a 3% inflationary environment, investors, whether it's domestic or abroad, might want to see that long-term yield a little bit higher, knowing that inflation is still here with risks to the upside. And that might just keep long-term yields kind of in that range right now of around 4 to maybe 4.25%. And I think that catches a lot of people off guard because we know that mortgage rates are tied more to the 10-year Treasury yield than they are to the Fed funds rate. We might not see that mortgage rate relief if that 10-year Treasury yield doesn't fall much further.
Yeah, and I mean, that obviously is the big concern, given we've started to see some green shoots, and the hope is some of the rates coming down would sort of alleviate some of the pressures on the housing market, but that remains to be seen. Collin, it's been an absolute pleasure. Thank you so much for joining us. Have a great weekend. Collin Martin, Director and Fixed Income Strategist, Schwab Centre for Financial Research.